In this project, we are going to learn about the great economic recession of 2008. Basically, in 2008, all the house prices collapsed, and basically, all the investors took their money out of the market. Basically, the whole economy of America collapsed, due to which effects were seen all over the world because America is a great powerhouse. So, basically, in this project, we are going to learn what happened, how structured finance rose into popularity, how it became the buzz boom in 2007, and how small mathematical errors in probability calculations led to the economic downfall of 2008. For this, first we have to begin by learning structured finance. Structured finance is nothing but a new way of repackaging risks. Basically, we all own assets, we all have some sort of portfolio. Basically, what happens is we in structured finance, the portfolio we restructure the portfolio in such a way that we get different sorts of bonds, and these bonds have different abilities. Basically, these bonds have different levels of security which they provide to us. Basically, instead of having n assets, all of them have different probability of default, or basically probability of falling off. We have a few bonds which each of them have different probabilities of default, and each of these bonds can be further traded into investors who are looking into invest in these bonds. This is called structured finance. Basically, structured finance is a two-step process. The first step is pooling and second step is tranching. In the pooling step, what happens is there are multiple assets which are available in the market, and we collect them into a single group. This group is called a specialized vehicle, special purpose vehicle. This is just a collection of these assets, and on these assets, what we are going to do is tranche. We are going to make multiple tranches, or basically multiple bonds. Each bond has a different sort of payoff system, such that there is a one single bond which is a very safe bond, and one single bond which basically shields the senior bonds from losses. So basically, this is the process of pooling and tranching. In pooling, we preferably make sure that the assets which go into the SPB are uncorrelated. Basically, what happens is in tranching we make a pool out of we make a pool out of all these n assets, and we make three tranches, and these tranches pay in a waterfall structure. Basically, what will happen is if there is any loss, first the loss is going to be absorbed by the junior bond. If the junior bond absorbs all of the losses, then it's okay. Else we will going to use the second senior bond, basically mezzanine bond, to absorb the rest of the losses. Basically, if the junior bond is not sufficient to absorb all the losses, the junior and the mezzanine bonds are going to absorb all the losses. In a very unlikely case where the mezzanine bonds is also not completely able to so-call the loss, then only the loss is going to be the loss is gone to the senior bonds. In other way, we can say that it is a reverse payoff structure. First of all, the senior bond is paid off, then the mezzanine bond, and if some money is left, then that money is sent to the junior bond. Basically, what happens is in this two-step process, we are going to achieve three benefits. The first benefit is risk transfer. Basically, what happens is earlier we had n assets, or whatever number of assets. Each of the asset had different probability of default, and each of the asset had different risk related to it. Now what we are going to have is we have a senior bond which is very safe bond, a junior bond which is a highly risky bond, and a mezzanine bond which is intermediate in between them. Basically, what happened is the risk, it was restructured into these three tranches, and these three tranches can be traded further. What happened is these n assets may not all be tradable. Basically, we cannot buy or sell these bonds into the market, but these tranches can easily be sold into the market, or basically traded for some money. So basically, what we are doing is we are creating liquidity into the economy. And third and most importantly, this is an asterisk symbol, because this was what was taught. Basically, when this concept was introduced, everybody saw that these bonds were giving more yields or more payoff than what was expected. Basically, for the risk involved, they were providing a lot higher yield, and that is why these bonds were very high in demand. But in later in the project, we are going to learn about capital asset pricing model. Basically, this provides another way of calculating another type of loss or risk, which opens our eyes and tells us that these bonds do not actually provide better yields, but they only provide better yields on paper only. These types of securities, there are multiple examples of them. CDO is the most common example, which was common in 2008, and these CDOs are the reason why the economy of US fell in 2008. MBS stands for mortgage-backed securities. Basically, in this pool, there are going to be a lot of mortgages, basically house loans, and ABS is asset-backed security. Why do we pool? Basically, pooling happens through centralized cash flow. Basically, in the initial case, there were n assets, and each of these assets were going to give us payoff individually, and we had to collect them individually. But now what is going to happen is there is a centralized cash flow. Basically, there is one bond, and this bond is going to pay and may not pay, and whatever intermediate value it has to pay. So basically, there is only a single cash flow involved over here, and we are also diversifying risk. This can be argued this can be proved also, but over here I am going to argue it by intuition. Basically, let us assume there are n assets in our portfolio, and these assets are roughly of equal amount basically, and P is the probability of default of each asset. Basically, this can be different also, but for intuition's sake, I am going to assume them to be equal, and rho is the pairwise correlation of the default probability. Basically, if rho is high, then if one bond fails, there is a high probability that another bond will also fail. But if rho is low, basically if one bond is if one bond fails, if rho is less than 0, if one bond fails, then the probability of the other bond ripening or giving us payoff is going to be increased than the previous anticipated value. Hence, this is rho is a pairwise correlation. Now, the expected return of this portfolio is 1 upon n times some summation over all the RIs. This is some central tendency of the returns of each of the individual assets. This is some central tendency that is representing our portfolio. If we apply, if we take out 1 by n outside, 1 by n square is going to come over here, and this comes from a formula which we are going to learn in CAPM later in the video. Now, what is going to happen is, as n goes to infinity and rho goes to 0, in these two conditions, this entire variance tends to 0. Basically, what happens is, the more number of bonds we are going to bring in the more number of assets we are going to bring in our portfolio, the less is the risk involved. It can also argued in simple layman words. Basically, if there is a single asset, then there is probability that it will default or it may not. But now what is going to happen is, for our whole portfolio to default, each of the individual or a major number of the individual assets are needed to be defaulted, which is less likely because there are multiple events, and probability in which a large number of events happen is going to be much less than probability of a single event happening. And hence we can argue that as the number of bonds increases, as the number of assets increase in our portfolio, the risk is going to tend to 0. It will not go exactly 0, but in certain cases it can also go 0. So basically, what is going to happen? The tail probabilities, the probability that all our assets go to 0, these are going to be set off. Basically, it is not going to be possible that the whole portfolio crash. Some part of the portfolio is going to provide us a profit. Some part of the portfolio is not going to provide us a profit. It will go into loss. But on an equal level, we are going to get some return RM from the portfolio. This is the concept of pooling. Now, tranching is a way to manufacture AAA bonds. AAA bonds are those bonds which are one of the most safest type of bonds. Basically, these are almost similar to the banks. Basically, if you can believe that the bank is not going to fail, then the AAA bonds are going to give us a similar sort of guarantee that these bonds are not going to fail, and these bonds are going to pay you with very high probability. Basically, what happens is, from assets which are not like that good, assets which are highly probable to default, we can make manufacture AAA bonds which are much more likely to ripe. And this is the concept of trenching. Basically, what happened is, we made a AAA bond out of these trash assets, and these trash assets, this AAA bond is further sold into the market. Now, if you now what happened is, this concept is just on paper. Basically, in practical life, as we are going to see further, trash assets are never going to provide AAA bonds, because in a case of a whole systematic failure of the economy, these AAA bonds are going to turn into trash only. And this is the concept, or the main reason behind the economic failure of 2008. We are going to look into more details as we go along the video. If we talk about some examples of structured finance, or some example on which on paper it reduces the risk involved in the AAA bond, then we can let us assume that we have two assets, 1 and 2. Their probabilities of default are P1 and P2, and rho is the correlation between them. Then the probability that the junior bond is going to fail. Let us define the junior bond, which is going to fail if any one of the bond is going to fail, and the senior bond, which it fails if both the bonds are going to fail. So basically, let us define this probability as PAB. PAB is the probability that both the bonds are going to fail. If rho is the correlation between them, PAB has a simple formula. PAB equal to P1 P2 plus rho times square root of P1 P2, 1 minus P1, 1 minus P2. So basically, this is approximately equal to P square plus P times rho. This quantity, if rho is very small, this quantity is comparable to P square, which means it is much less than P1, single P. Which means this is a AAA type of security. Basically, these are a highly secure type of investment. A junior bond is going to fail if any one or both of the bonds are going to fail. Basically, the probability is equal to P1 plus P2 minus PAB. A junior bond might not be that good of a bond as compared to senior bond, but they are also very high in demand, because some people in the market are going for higher risk investments. Basically, investment that is going to provide quick cash. So these bonds are also very eager to be bought and sold. So basically, in this example, we saw that how two assets, P1 and P2, they had a very high probability of default, but together the probability of default is somewhere around P square. If we look at another 3 bond example, basically we make 3 bonds out of 3 individual assets, and each of the assets is uncorrelated with each other, and each of the assets is going to default with the probability P. So now we have 3 bonds over here: senior bond, mezzanine bond, and junior bond. The senior bond is going to default only and only if all 3 of the bonds are going to default. So basically, the probability of default is PQ for the uncorrelated case. For the mezzanine bonds, at least 2 of the bonds must default. So this is the probability. This is comparable to P square, and this is comparable to P. This is comparable to PQ. So basically, we can see that these type of bonds are going to be very auspicious type of bonds, very high secure bonds. This is some of the basic concepts behind structured finance. If we plot these graphs, the graphs are going to look somewhat like this. Basically, senior bond is going to pay off most of the times. This graph is plotted with respect to default probability. The junior bond is going to go to 0 very quickly as P goes to 1, and this the intermediate tranche or the mezzanine bond is going to lie between them. This is approximately P cube. This is P square. It is order of P square basically, and this is order of P. Next, we are going to learn about risk and different types of risk which comes along with trading economic instruments. Basically, there are 2 types of risk: systematic risk and idiosyncratic risk. Basically, systematic risks are those risks in layman words, which are involved with the economy. Basically, if the whole economy falls down, then your portfolio will also fall down. This is basically all the risk which is proportional to the market. Idiosyncratic risks are those risks which are involved on an individual level. Basically, the risk in which a simple asset or basically an investment which you made did not return, basically it defaulted. This idiosyncratic risk is not a big deal, but the systematic risk, when this happens, when this probability that the entire market collapses becomes a global crisis. If I talk about the scope, these risks go to the entire market, while the non-systematic risks are only limited to a certain stock or company or industry. If I talk about the diversifiability, systematic risks can be mitigated cannot be mitigated easily. Basically, if you diversify your portfolio, the systematic risk will never go down. But if the non-systematic risk, basically, if you take some stocks in healthcare, some in education, some in edtech, and some in fintech, the probability that all these markets go down at the same time is very low. So basically, with diversification, you have saved your portfolio from these type of risks. But for systematic risks, you need to go full on hedging. Hedging is basically you understand very deeply where your portfolio stands, and you take a stock or an investment which is completely opposite to your current portfolio. Basically, if you make sure to buy a stock which will always increase if the entire portfolio decreases. In this case, you minimize your loss. Example of these risks happening in real life is a 2008 global crisis. For non-systematic risks, you can consider any case in which, let's say, some CEOs just stepped down or they were kicked. Now talking about rating systems, basically the Moody, S&P and Fitch, these are companies that rate financial instruments. Basically, they rate securities on their quality. A security is any tradable or investable financial instrument, and quality in here means like consistent cash flow and risk. Basically, they tell you which bonds are going to provide you the best returns for the minimum risk. They basically see the default probability, that the probability your bond is not going to pay you up, or what amount of bond, what portion of the bond is exposed or at risk. Now the AAA investments are the safest forms of investment. Now in 2007, the structured finance instruments were rated AAA a lot. So basically, what happened is, before 2008, 60% of the tranches, CD of tranches, were AAA. So basically, a lot, like 60% of the economy were dealing with structured finance only. But after 2008, the blind trust which they had before the financial crisis, it was shattered. Now the structured finance objects are looked upon with extreme scrutiny. They stress test these bonds like 80% to 80% systematic risk. Basically, they make sure that they are not going to, another crisis is not going to happen again. If you talk about exact numbers, the Fitch rating system basically rates bonds from AAA to C basically, and they look at the 10-year default probability and comparing these numbers. They basically calculate what type of bond you are going to have. Basically, it divides bonds on the basis of default probability, 10-year default probability. Next, to talk about CDO. CDO stands for collateralized debt obligation. Basically, these are a large pool of assets or mortgages or loans which come together, and these are pulled together to form tranches or three forms: junior, mezzanine, and senior. This we already know, but what is different here is the standardization. We already standardized that the first 5% of the loss is absorbed by the junior bond, next 5 to 15% of the loss is absorbed by the mezzanine bond, and the final whatever loss is left, it is going to go into the senior bond. Now what is happening is, it is very unlikely for a large number of assets to fail at the same time, which makes the senior tranches very, very safe. So basically, usually the senior tranches are AAA and the mezzanine tranches are usually BBB. Junior Now these tranches are usually sold separately to people who are looking to invest in these uh, bonds. Now what is a CDO square? Basically we pool together multiple mezzanine bonds. Basically junior bonds are bought by people who are play high risk, and senior bonds are bought by people who play very low risk. So these mezzanine bonds which are left over, they are pooled together to form a CDO square forms of bonds. Basically these mezzanine tranches become the pool out of which we again make three types of tranches: junior, mezzanine and senior. Now what is going to happen if we combine a 5 to 10 triple B mezzanine bonds? The mezzanine pseudo square bond is A and the senior bond is triple A. Basically it is more than the underlying asset itself. Similarly, we can combine pseudo square tranches to make pseudo cube and pseudo cube tranches to make pseudo 4. This makes a tree type of structure in which the pseudo branches at the top are going to totally determine what is going to happen in the leaf nodes. If we talk about exact number, then these are the numbers which tell us about what is the amount of rating that these bonds are going to have. As we can see that usually with structured finance, we can easily make a lot of AAA securities and people can deal with buy and sell them is very easily. Now the problem is the sensitivity. Basically these bonds, what is going to happen that even at the base level, at the pseudo level, if we make some small error in calculating probability of default, this error is going to get amplified, and when it goes to the leaf node, basically pseudo power n, a lot, even a small change in probability will make a AAA bond to go into junk category. Basically the bonds which no one wants to deal. So basically this makes the question that if a single probability calculation becomes very complicated and a small error happens in marking these bonds as AAA, then a large economic loss is going to happen for a large number of investors, and the company's credibility is going to shatter. Further, we need to discuss about the sensitivity of CDOs. Basically, if we take an example or think intuitively that the assets are all positively correlated with each other, then the probability of default is not very less than the probability of default of each asset. Basically, if all the bonds are 100% positively correlated, then the probability of default is a central tendency which comes from the set from P1 to Pn, the probability of defaults from each of the assets. Basically this number is of the order of the probability of default of each of the asset, which this is very large as compared to probability of default which was offered or basically promised by diversification, which means that if the correlation between assets is very high, then the probability of default is very high and there will be no diversification benefits. So basically from one end of the spectrum with a large diversification benefit to the other end which there is correlation one and there are no diversification benefit, we need to understand like what is going to happen over here. This is a graph which is simulated by making 100 underlying assets, and we are going to find the probability of default by generating 100 random numbers which are correlated with each other. Now, if a certain number falls below the specified probability of default, then that exact asset is going to default, and the losses are going to be absorbed in the waterfall structure. Now these are the pseudo bonds and these are the pseudo square bonds. Now for the baseline we have taken rho equal to 20% and probability equal to 10%. In these 5%, probability of default is 5%. Now as we can clearly see in this structure, as we go near to the end, basically the probability correlation is going to be very high. A lot of bonds are going to fall off from the collateral. Basically the junior bond is going to go above the line. Basically these bonds are going to get more and more Basically, the point of the junior bond is not to provide for any value, because these bonds are already very trash. They are very very high risk. They are not going to provide a lot of expected payoff. These are going to provide only high risk payoffs in the tail cases. So basically, there is no aim for these junior bonds to give high payoff. Our aim was to absorb the losses in these junior bonds. So basically, when the probability is very high, these mezzanine and senior bonds, they fall below the collateral line. Here we can see that there is still a very less variation. But if we talk about pseudo square, basically the correlation, the effect of correlation is a lot amplified over here. Basically, a small error over here from 0.7 to 0.8, it will correspond to a lot of error over here. Hence, if we, like for example, we were talking about 0.2. At 0.2, these all the graphs meet over here. But as we go up, it falls off very quickly. Hence, we need to understand that these bonds are very very fragile. If we make error over here, the same arguments can be made for the value of probability of default. For the pseudo cases, they show a dip, but that dip is not very high. But for the pseudo square, this dip is very 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 high. If even a small error happens in our probability of default, the probability of default for the whole pseudo square bond is going to go from AAA to literally like somewhat C, AAA to C. This explains why we need to be very very careful while calculating CDOs, basically manufacturing AAA securities, because these securities are very very fragile. To understand the financial economic crisis of 2008, we need to first understand what capital asset pricing model is. This model brings another approach to understand how the economy collapsed in 2008. This model is basically a macroeconomic model which maps the systematic risk of a portfolio or an asset to the expected return that the portfolio should provide for our investment to be worthwhile. Basically, this is a model which divides our investments into three categories. The categories which are overvalued, undervalued, or fair. Overvalued investments are those investments which are not providing the return which for the risk we are going to bear for that investment. And the undervalued investments are those golden opportunity investments which are providing the best value for the risk we are going to take. And the third category are the fair investments which lie on this model. Basically, this model provides us with this relationship. This relationship provides a upper bound or the lower bound basically on the expected return of our investment. If the investment is below this value, then the asset is not worth investing into. Better than that, we could have invested in the open market, and we would have got better returns from that. Basically, this is a relationship where beta I is the sensitivity of the asset I, which is calculated from this expression. If you talk about all the terms in this expression, RF is the risk-free rate. Basically, this is the constant rate of interest which is provided by the central bank of whatever country we are residing in. RM is the expected return of the market M. Basically, all the assets that are available in the market. A compound return basically for the entire plethora of assets is the market basically. RI is the return of the asset I. Here we need to understand that since RF is a constant, this is a fixed value. But RI and RM, basically the expected returns of market and asset I, are going to be values which are going to be found out in the future. So basically these are random variables and we are going to find expectation of these values. So in this expression we can see that for RI and RM we are going to use expected values correspondingly. But for RF we are going to use the exact value. RI, RF and RM as told are the expected returns. This quantity, expected value of market return and minus the return of the free market, is called a risk premium. Basically, If we invest in the market M, if we invest directly in the market, we are going to get some returns. So we need to assess whether investing in the asset I is more beneficial than the market or not. Hence, this is the return basically, or the premium we are going to get in investing in the open market. So if we are going to invest in the open market, so if we are not going to invest in the open market, we should get some compensation. So the compensation that we are going to get is given by this formula, and this quantity is going to be called the risk premium. Beta is the sensitivity of the asset I with respect to the market. Basically, it tells us if the market is going to go up, is it going to bring any impact on our asset? If the asset goes along with the market, then the how much likely it is going to go along with the market is called a sensitivity beta I. This expression tells us the value of the beta I. It is the covariance of the return Ri and Rm divided by the variance of the return Rm. If we talk about the expressions and terminology, sigma square xy is the covariance of x comma y, whereas variance of sigma square x is the variance of random variable x. If I talk about beta I, if beta I is greater than 1, it means that asset I is going to be more risky than the market. But if beta is less than 1, then the asset I is safer as compared to the market. The more the beta is, basically more risky we are going to invest. Hence, we are going to demand a better compensation from the market for this investment, for the more riskier investment. If beta is less than 0, this means that we are going to go against the market. We are going to earn money if the market goes down. So basically, it is similar to a sell option on the market economy. It is some sort of an insurance against the market. Here we need Ri and Rm are random variables, and if we these are going to be future values. Expected value of Rm can be computed in Rf, we already know. So as compared to beta I, the locus of expected value of Ri, if we plot this, we are going to get the straight line. This is basically a linear relationship between expected return and the sensitivity of asset I. If we plot this, we are going to get this line. This line is called the security market line. Any portfolio that lies below this line is going to be an overvalued asset. Basically, we can get this asset which lies on this line. This asset is, as compared to this below asset, is going to have less risk and more return. Similarly, any asset which is going to lie above this line is going to having better returns and less risk as compared to this market line. If we talk about this line, the line is always going to be greater than Rf. Basically, we are investing in some sort of an asset. Hence, obviously, we are expecting a return greater than Rf. So Rf is the intercept, and the basically the premium is going to be the slope. If we use an example, for these values of beta, Rf and expected value of Rm, the expected value of Ri is going to be 14 as per this graph. Hence, if the asset I is not going to give us 14% interest minimum, then we are not going to invest. This investment is going to be a bad investment. If we talk about the derivation of this formula, we need to consider a portfolio, and this portfolio is made up of multiple assets and this risk-free portion. This multiple assets can be seen as a market. Basically, a market is the combination of all the assets in the economy. So basically, some portions of the market is this. Basically, our other half of other portfolio. This is going to be a risk-free portion, and we are considering whether we need to invest in the asset I or not. So basically, we need to consider what happens if we invest a small portion alpha from a risk-free portion. This portion we are going to remove and allow asset I to take this place. So if we do this, we are going to see an increase in our expected return as well as the variance. So basically, we need to calculate what will be the increase in variance and return of portfolio. The increase in return of portfolio is simple to calculate. Basically, we are not going to get the risk-free interest, which is alpha RF, but we are going to get the interest of alpha expected value of RI. So if we add this and subtract RF, this is going to be the increase in the expected return of the portfolio. Here we need to understand that alpha is a very small quantity. We can call it a differential element. Now, to calculate the increase in variance of the portfolio, we need to understand two formulas, this formula and this formula. This formula basically, given the sum of random variables ai, we can break it into this complicated expression, but each of these terms are much simpler to calculate. Basically, the variance of this entire random variable is equal to summation of variances of each of these random variables plus summation of all the pairwise covariance matrices or covariance values. Another formula we are going to use is covariance of x plus y with respect to z is going to be covariance of x with respect to z and plus covariance of y with respect to z. Basically, we can divide the covariance value function. Basically, using 1 and 2, we are going to get increase in variance as, since RF is going to be a risk-free interest, it is not going to have any covariance with any other asset. Also, since RF is a constant value, we are not going to see any variance for this RF value. Instead of RF, we are going to increase our portfolio by alpha RI. Basically, RI is the interest of the asset I and alpha is the amount we are going to invest. So we are going to see an increase in variance of the portfolio. Basically, alpha RI is going to come over here and here. So here alpha is going to come out and it will become alpha square. Since alpha is a very small differential quantity, this quantity will be very small and we can call it 0. On this other hand, basically RI is going to get covariance is going to be calculated for all other assets. So basically we can roughly call it the market. Basically, we are going to use this expression backwards and we will call it covariance of RI comma RM. Basically, the covariance of the asset I with respect to the market return. This is the increase with respect to increase in the variance of our portfolio. If we calculate a marginal trade-off, this is a quantity which comes from modern portfolio theory. It tells us how much return we should expect if we are investing a little more on the risky asset. Basically, this is going to be if for 1 unit increase in variance, how much our portfolio should increase. This quantity, if we calculate over here, it is going to be constant with respect to, it is going to be a constant, which is this. Now, at equilibrium, this value is going to be same for all assets 1 to whatever n, whatever number of assets are there in the market. If we want to argue over this relationship comes from no arbitrage condition and demand and supply. Basically, if we assume there are two assets I and J, and I is providing more trade-off as compared to J, then I is going to be a better investment as compared to J, and people are going to be willing to invest in I more, which means that I is going to be more in demand, but the supply of I is going to be constant, which means that I will be the cost of I is going to rise. Since I is going more in demand, the investment J is going to be go below. Basically, it is going to get less demand and less cost. Since I is going to be more cost here, we will get less return on investing in I. So basically, the expected trade-off of I is going to go down and expected trade-off of J is going to go up. Basically, what will happen is this movement is going to stop when I is trade-off is same for I and J. So basically, this trade-off is going to be same for asset I and asset J. So basically, we are going to get this expression. Now from over here, we are going to use theorem of ratio. It says that let's say we have n fractions, and in the numerator and denominator, these fractions are equal. Basically, these are numerators and these are denominators. So basically we are going to take a linear combination of the numerator and we are going to take the same linear combination of the denominator. So basically if we take this ratio is also going to be same as compared to each of the individual fraction which is over here. So same we are going to take a linear combination of each of the numerator and each of the denominator separately. So basically we are going to take the linear combination in such a way that each of the asset I, j and whatever up to n together they make up the market. Expectation can be broken and brought together in summation. Using that we can write Rm in the place of Ri. Similarly in the place of Ri we are going to use Rm, and since covariance of x comma x is variance of x, this we are going to get this expression. Now if we equate this with our initial expression, we are going to get our desired expression, which is expected value of Ri is equal to Ra plus beta I times the risk premium. This is our final expression. And if we talk about why this model is important while analyzing the fall of the market of 2008, we need to understand that this model talks about the systematic risk. Basically, if we invest in a asset which is riskier than the market, then we should expect more compensation for it. So what has happened was the AAA securities that were listed in by the various companies, they were listed as AAA security, but actually they had a lot of systematic risk involved with them, which was underestimated by the rating companies. The companies which rated these securities underestimated the systematic risk and only calculated the default probability. Basically, the probability given the assets are completely uncorrelated with the market, and using that they used to sell these securities. So what happened was, since in reality there was a large beta I involved with these securities, the expected return which these securities should have given us should be large, but they were sold at the basic rate of interest which they calculated using beta I equal to 0. In that case what happened was, basically these securities were in actuality trash securities. They did not provide us sufficient return for our investment. Basically our whole economy, every investor was going to invest in these AAA securities believing that these securities are going to be safe, but in reality these were not at all safe, and basically we were investing in junk bonds which were, the money was obviously going to be lost. In the research paper it is also explained that instead of investing over here, it was better to put a digital call option on the economy. A digital call option is a bet, basically $1 bet, which basically gives you the money if the economy is above a certain strike value. This is a strike value, and if the economy is above this, we are going to get $1. So if we had put digital call options on the economy, we would have got better returns as compared to these AAA securities. As the final conclusion of the project, we are going to understand how the economy of 2008 fell. Basically, as we saw during the rise of structured finance, there were a lot of structured finance assets, basically structured finance instruments which offered a lot of return for very little risk. Basically AAA bonds which offered a lot of return for what risk they were offering, but in actuality the risk was a lot underestimated. Basically there was a lot of systematic risk which we had seen in CAPM, but it was never calculated while offering these structured finance materials. Also, there was also a lot of correlation which was underestimated, due to which they only actually in reality they were highly risky mortgages, or basically highly risky instruments, but since they offered more and a lot of finance companies just gave them AAA ratings, a lot of investors were highly demanding these instruments. So basically the demand rose, and basically a lot of assets were being pooled over to make these bonds. So since there became a lot of demand, and assets were going to diminish at some point of time. So basically they had to bring new assets to calculate make these bonds. Basically not. Then what they did was they started making CDO progeny. Basically they made a CDO, then they made a CDO square from these CDOs, then they made a CDO cube and a CDO raised to power 4 and so on. At some point of time these methods were also going to get over, and they had to make something up to start to meet the demand of these structured finance objects. Now what happened was they started giving mortgages to subprime people. Basically, as per credit score, banks divide people into three categories: prime category, alt prime, and subprime. Prime people are those people who, if given a loan, they would certainly repay the loan, and they had done so in the past. So banks used to trust them blindly. These are the prime people. Alt prime people are those people who have credit score, sufficient credit score, but they haven't. But they still the bank did not trust them blindly. And the subprime people are those people who did not even have a sufficient credit score to get a home loan. Now what happened was, since they were in a banks were in a hurry to make bonds, structured finance objects. So what they did was they started started giving mortgages to subprime people. Basically, the house market, the house prices were always increasing, and they were sure that the house prices were never going to fall down. So they were pretty much confirmed that these subprime mortgages, the values of these houses were going to go up, and once these prices were going to go up, the people were going to repay the loan. They would earn the money in some form, and they would repay the loan, and nothing wrong is going to happen. But as more and more CDOs were formed, the demand rose, and the subprime mortgages started to flood in, basically. And what started happening, that the CDOs which were formed from these subprime mortgages was already as risky, because these people already have high probability of default. But the correlation between them was also very high, because in a locality, a large number of people were going to be poor, and if a large number of people were going to be poor and they have a lot of house loan, it is a very high probability that all the people in that area were going to default. It was not very likely that a group of 10 people living nearby, only one house is going to default and 9 others were not going to default. If a single house even defaulted, it was very, very likely that the other 9 houses were also going to default, which means that we were underestimating a lot of correlation between these subprime mortgages. And the power of structured finance was shown only when there was a lot of uncorrelation. Basically, correlation was less, but these were highly correlated mortgages. So basically, we were already wandering in dangerous territory over here. The correlation was highly underestimated, and what happened was, what happened is, if we look at this graph, or basically this table, as we can see that as we go into more correlation, even the AAA bonds go into BBB categories. Basically, this is a senior CDO tranche and senior CDO square tranche. So basically, if a single these subprime mortgages have the correlation increase from 20 to 40, all these security that the AAA bonds offered, they were ripped apart. Similarly, over here, all the benefits were ripped apart, and basically what happened was, these become very, very highly risky, or basically they were not investment grade, they were only speculative grade bonds. Now further, what happened was, it was just a point in time when the loans were starting to get defaulted. So basically, when a single loan defaulted, the banks became very scared and started aggressively chasing loans. Basically, started forcing people to pay up, because a bank had given them mortgages and they had to pay, or else this model was going to fail. So basically, they started chasing these loans, and more mortgages defaulted. But the bank did not realize that once they would confiscate these houses and they would try to resell them, the resale value of the house was going to be very less as compared to the original value. As well as, when people saw that instead of buying a new house, and taking a mortgage, they would simply buy these houses were much cheaper, which were much cheaper. So they did not like the house prices began to fall down. And when the house prices began to fall down, the people who make intelligent investment, basically the prime families who have enough money, they saw that the investment in the house was not really worth it. So they also started defaulting. Basically, what happened was even prime families defaulted their loan, subprime families defaulted their own loan, all families defaulted their loan. All the loans were getting defaulted, and there was a surplus of houses and very less number of people going to buy. So basically, the supply was very high and the demand was very low. So basically, what happened? The house prices just dipped very hard, and that led to the fall of the economy in 2008. Basically, these CDOs, they all depended on the mortgages, and when the mortgages started to default, a large number of economy and a large number of around 60% of the economy was now dealing with structured finance instruments, and all these instruments collapsed in a single year. So hence the economy collapsed, and that led to the fall of the economy in 2008. So we learned how simple miscalculation in correlation values, or simple miscalculation in understanding probabilities of default. We could not calculate a systematic error or systematic risk involved in trading these objects, and this led to a mass economic crisis all over the world.